In December 2012, one of Wall Street's most confident billionaires stepped onto a global stage and declared a company would collapse to zero. Bill Ackman wasn't quietly placing a bet. He was announcing financial extinction. He revealed a $1 billion short position against Herbalife, a multi-level marketing giant operating in over 80 countries. The market didn't panic. It did something worse. It watched. Ackman delivered a multi-hour presentation accusing Herbalife of being a disguised pyramid scheme, predicting regulators would destroy the company and investors would be wiped out. His confidence was absolute. His data appeared overwhelming. His reputation amplified the threat. But inside this moment, a dangerous leadership pattern was already forming. The bet was no longer just financial. It became psychological warfare. Because when elite investors publicly commit to a thesis at this scale, retreat becomes nearly impossible. Reputation, credibility, and legacy quietly become leverage. And leverage has destroyed more empires than bad math ever has. The real risk was not Herbalife's business model. It was whether Ackman had unknowingly trapped himself inside his own certainty. Bill Ackman wasn't gambling. He believed he was repeating history successfully. Just a few years earlier, he had exposed questionable business practices at another company, turning deep forensic research into massive profit and reputation growth. That victory quietly reshaped his internal decision framework. He began trusting a powerful mental shortcut. If investigative research uncovered structural flaws once, it could do it again. Ackman and his team spent months building a complex analytical case against Herbalife. They dissected distributor structures, recruitment incentives, and revenue flows. Each new dataset reinforced a singular conclusion. The company survived primarily through endless recruitment layers. And every reinforcement made the thesis stronger inside his organization. But reinforcement can create a dangerous cognitive trap. The more evidence that confirms a belief, the less likely leaders search for a disconfirming reality. Hedge funds often describe this as high-conviction investing. Inside decision psychology, it can slowly become confirmation insulation. Meanwhile, outside Ackman's research bubble, Herbalife wasn't collapsing. The company continued reporting revenue growth, expanding markets, and maintaining distributor momentum. The contradiction wasn't weakening Ackman's confidence. It was strengthening his determination. Ackman's presentation triggered something few financial positions ever do. It transformed a market trade into a global ideological conflict. Within weeks, other billionaire investors began publicly taking the opposite side. The most dangerous among them was Carl Icahn, a legendary activist investor with a long history of corporate combat. Icahn didn't just buy Herbalife shares. He announced it aggressively, directly challenging Ackman's conclusions. The short position suddenly faced a structural problem. Short selling carries unlimited loss potential. When opponents with massive capital deliberately push stock prices higher, short sellers face escalating financial pressure. But for Ackman, this battle was evolving beyond capital risk. It became reputation escalation. Every public interview, debate appearance, and investor letter increased emotional and political investment into the thesis. Walking away would signal weakness. Doubling down signaled strength, even if risk multiplied quietly. Financial markets are often described as data-driven ecosystems. In reality, they frequently become arenas of ego preservation. And as Ackman intensified his public attacks on Herbalife's business ethics, Icahn escalated his financial defense of the company. The trade stopped being about Herbalife's collapse. It became about which billionaire could afford to be wrong longer. As Herbalife's stock price refused to collapse, Ackman's position entered a silent danger zone few outside hedge fund mechanics fully understand. Short positions don't just require being correct eventually. They require surviving long enough to prove it. Every upward price movement forces additional capital commitments, margin pressure, and investor scrutiny inside the fund. Liquidity quietly becomes survival oxygen. Ackman's fund structure allowed him to sustain losses temporarily. But sustaining losses while publicly defending them created a compounding incentive trap. Admitting uncertainty could trigger investor withdrawals. Maintaining certainty required escalating public conviction. Meanwhile, Herbalife executed aggressive share buybacks and maintained strong distributor engagement. Each corporate move applied incremental financial pressure on the short thesis. Inside Pershing Square, Ackman's hedge fund, the bet was no longer just an investment. It became an organizational identity statement. Teams, investors, and analysts were psychologically aligned around proving the thesis correct. This alignment created internal unity. It also created dangerous blindness. Because once organizations tie credibility to a single prediction, new warning signals often appear as temporary noise rather than structural threats. And liquidity crises rarely announce themselves loudly. They suffocate slowly. Ackman's entire thesis relied on a single decisive catalyst. He wasn't betting Herbalife would fail naturally. He was betting regulators would intervene and legally dismantle the company's business structure. In public presentations, Ackman repeatedly pointed toward U.S. regulatory agencies, particularly the Federal Trade Commission, as the eventual execution mechanism. His data framed Herbalife as a recruitment-driven system designed to collapse when new distributors stopped entering the chain. But regulatory timelines operate on political, legal, and bureaucratic rhythms, not investor expectations. And those rhythms move slowly. While Ackman increased public pressure, regulators maintained investigative silence. No confirmations. No rejections. Just prolonged uncertainty. This created a structural asymmetry inside the trade. Herbalife could continue operating, generating revenue, and stabilizing its distributor network while the short thesis waited for a government decision that had no guaranteed timeline. Waiting in financial markets carries a hidden cost. Time amplifies capital pressure, emotional commitment, and investor scrutiny simultaneously. And as months passed without decisive regulatory action, Ackman's conviction began colliding with a dangerous reality. The catalyst he needed was outside his control. And power often collapses when it mistakes influence for authority. Instead of collapsing under pressure, Herbalife stock began attracting an unexpected form of reinforcement. Institutional investors, retail traders, and rival hedge funds recognized the public nature of Ackman's position and identified a structural vulnerability inside it. Short positions with massive public exposure often create an unusual market incentive. Opponents don't just profit from price increases. They profit from forcing short sellers into escalating defensive capital commitments. Herbalife's share price started climbing. Each upward movement triggered increased borrowing costs, margin pressure, and investor concern inside Pershing Square. Ackman responded by strengthening his public narrative, releasing additional research, and doubling down on distributor-level analysis. But markets do not always respond to evidence. They respond to incentives, liquidity flows, and psychological momentum. Meanwhile, Icahn and other investors continued purchasing shares, strengthening Herbalife's capital structure and signaling market confidence. The trade evolved into something structurally dangerous, a feedback loop where the act of defending the short position increased attention, and attention increased opposition. Ackman was still focused on being correct. The market was focused on who could survive longer. And survival is rarely determined by data alone. By 2014, the Herbalife battle had transformed into one of the most public hedge fund conflicts in modern financial history. Ackman was no longer simply managing a high-risk trade. He was defending a public intellectual stance about corporate ethics, investor responsibility, and market integrity. And reputation began functioning as leverage. The more Ackman publicly accused Herbalife of exploiting distributors, the more psychologically and professionally expensive retreat became. Hedge fund leadership often relies on perceived conviction strength to maintain investor trust. A visible reversal can trigger doubts not just about one trade, but about an entire analytical framework. Inside Pershing Square, the Herbalife position had evolved into a narrative cornerstone. Analysts, investors, and institutional partners were psychologically aligned around proving the thesis correct. This alignment created internal momentum that made reconsideration increasingly difficult. Meanwhile, Herbalife adapted strategically. The company increased transparency efforts, strengthened compliance messaging, and expanded international distributor growth. Each corporate adjustment weakened the inevitability narrative Ackman had built. But conviction-driven leadership rarely interprets adaptation as contradiction. It often interprets it as resistance. And resistance frequently justifies escalation. In 2016, after years of public accusations, research battles, and financial escalation, regulators finally delivered their decision. The Federal Trade Commission announced a settlement with Herbalife following an extensive investigation into the company's business practices. For Ackman, this moment was supposed to validate the entire thesis. Instead, it delivered a strategic contradiction. The FTC forced Herbalife to restructure distributor compensation, implement compliance reforms, and pay a significant financial penalty. Regulators acknowledged serious operational concerns. But they stopped short of declaring Herbalife a pyramid scheme or shutting the company down. Markets reacted immediately. Herbalife's stock stabilized. Investor confidence strengthened. The existential collapse Ackman predicted never materialized. His thesis wasn't fully disproven, but it was structurally weakened in the one place it needed absolute validation. This outcome triggered a dangerous realization inside large conviction trades. Being partially correct can still produce catastrophic financial outcomes if timing, enforcement, and market reaction diverge from the original model. Ackman had exposed structural weaknesses, but the system had survived them. And in corporate power ecosystems, survival often matters more than theoretical vulnerability. After the FTC settlement, Ackman's thesis entered its most dangerous phase, the phase where collapse doesn't happen, but the trade also cannot emotionally or financially end without consequences. Herbalife adjusted its compensation model, strengthened compliance systems, and repositioned itself publicly as a reformed company. The business did not implode. Distributors continued operating. Revenues stabilized. Market confidence slowly returned. Ackman faced a structural dilemma common in high-conviction financial warfare. His research still identified long-term vulnerabilities inside the company's recruitment model. But financial markets operate on survivability horizons, not theoretical fragility. Being early in a collapse thesis creates an invisible trap. The longer a system survives, the stronger market perception becomes that it is resilient. Each year, Herbalife remained operational weakened the inevitability narrative that originally justified the short. Meanwhile, Pershing Square investors began questioning capital allocation strategy. Large short positions tie up liquidity, restrict new opportunities, and create internal performance pressure across the fund's portfolio. Ackman wasn't just defending a trade anymore. He was defending the cost of years already spent proving it. And sunk cost logic rarely produces rational exits. By 2018, Ackman began quietly restructuring his Herbalife position. The shift wasn't a sudden closure. It was a gradual transformation from a direct short into complex option strategies designed to limit losses while preserving narrative consistency. This type of exit reflects a recurring leadership behavior pattern inside elite decision environments. Leaders rarely abandon public positions abruptly. They engineer transitions that soften reputational damage while controlling financial fallout. Ackman publicly reframed the position as a tactical evolution rather than a strategic retreat. But markets understood the signal immediately. The most aggressive collapse prediction in modern hedge fund history was losing structural momentum. The financial losses were substantial, but the deeper cost emerged in credibility recalibration. Hedge funds depend heavily on investor trust, and high-profile failures reshape how institutions evaluate future conviction claims. Meanwhile, Herbalife's stock price climbed higher, fueled by buybacks, investor stabilization, and operational adjustments. The system Ackman predicted would collapse had instead demonstrated institutional survival flexibility. And corporate systems that survive high-profile attacks often emerge stronger because resistance forces structural adaptation. Ackman had identified real vulnerabilities, but he underestimated the adaptive intelligence of corporate survival ecosystems. Ackman eventually closed the Herbalife position, confirming billions in losses across years of sustained financial and reputational warfare. The defeat wasn't just numerical. It became one of the most analyzed investor miscalculations in modern financial history. But what made the collapse intellectually significant wasn't incorrect research alone. Ackman's investigative work revealed legitimate structural concerns inside Herbalife's distribution incentives. Regulatory action partially validated operational risks. The vulnerability existed. The failure emerged from something more dangerous: overconfidence in pattern repetition. Ackman believed he had discovered a repeatable formula: identify structurally flawed companies, apply public pressure, trigger regulatory collapse, and profit from systemic exposure. That formula had worked before. But corporate ecosystems are not static. When a pattern becomes visible, systems adapt, opponents counterposition, and market incentives evolve. The deeper psychological lesson emerged quietly across Wall Street. Elite investors rarely collapse because they lack intelligence or research discipline. They collapse because past victories create decision models that appear universally reliable. And universal models rarely survive dynamic power systems. The Herbalife battle ended as a financial defeat for Ackman, but its deeper significance extended far beyond a single hedge fund loss. It exposed one of the most dangerous repeating patterns inside corporate and financial power structures. Success creates analytical confidence. Confidence builds conviction. Conviction reduces doubt tolerance. Reduced doubt blinds leaders to system adaptation. This pattern appears across industries, from investment firms to technology monopolies, banking institutions, and global corporate empires. Leaders begin trusting their internal frameworks more than evolving external reality. Ackman correctly identified structural risks inside Herbalife. But he miscalculated survivability variables, opponent incentives, regulatory unpredictability, and time-based capital pressure. Power rarely collapses because weaknesses are invisible. Power collapses because leaders assume visibility guarantees control. The Herbalife story never proved that Ackman's concerns were meaningless. It proved something far more unsettling. In complex systems, being right about vulnerability does not guarantee victory over survival. And across corporate history, collapse rarely belongs to the weakest structure. It often belongs to the leader most convinced they have already solved the pattern. When Ackman closed the Herbalife position, Wall Street treated it as a rare public defeat for one of the industry's most influential activist investors. The headlines focused on billions lost, reputational damage, and the end of a legendary financial battle. But inside institutional investing circles, the real aftermath unfolded more quietly. Pershing Square survived. Ackman continued managing capital. His firm later delivered major investment successes that rebuilt performance credibility. The system moved forward, just as it always does after high-profile decision disasters. And that continuation hides one of the most dangerous illusions inside financial power ecosystems. Survival often masks structural decision failures. Markets rarely punish analytical overconfidence permanently. They recycle leadership credibility once performance rebounds. This creates a hidden incentive cycle where elite decision-makers subconsciously trust conviction frameworks that previously collapsed. Meanwhile, Herbalife itself survived regulatory pressure, public scrutiny, and activist attacks by adapting its compensation model, strengthening compliance language, and repositioning its distributor narrative. The company did not become immune to criticism, but it proved corporate ecosystems can evolve faster than external collapse predictions. Both sides survived, which is precisely why the deeper pattern remained invisible. Because when both attacker and target continue operating, the system never fully interrogates the psychological chain that created the conflict in the first place. The Ackman-Herbalife conflict revealed a pattern that repeatedly appears across corporate, technological, and financial empires. Leaders do not collapse because they lack intelligence or research. They collapse because they trust their analytical framework more than system unpredictability. This same psychological architecture has shaped some of the largest power collapses in modern history. Investment funds before major financial crashes built sophisticated models proving mortgage securities were safe, until liquidity systems broke overnight. Technology companies dominated markets through disruptive innovation, until internal conviction blinded them to cultural shifts and competitor adaptation. Banking institutions created financial engineering systems designed to eliminate risk, until the very models designed to control uncertainty amplified systemic collapse. In every case, leaders were not uninformed. They were overinformed within a single interpretive lens. Ackman's Herbalife thesis revealed genuine structural risk. But once conviction escalated publicly, psychological flexibility disappeared. And in power systems, rigidity becomes a liability long before collapse becomes visible. This pattern does not belong to one hedge fund or one company. It belongs to how authority processes success. The most dangerous part of repeating decision disasters is that they rarely feel dangerous while forming. Today, financial and corporate power structures are building conviction models around emerging technologies, global market expansion, and algorithm-driven investment frameworks. Artificial intelligence prediction models, quantitative trading systems, and corporate growth narratives are creating new layers of analytical confidence. These systems produce massive success, and success strengthens belief in the frameworks generating it. But history suggests something unsettling. The stronger leaders believe they have finally mastered complexity, the more fragile their decision architecture often becomes. Markets evolve. Competitors adapt. Regulators intervene unpredictably. Liquidity flows shift without warning. And when those variables collide, collapse rarely begins with ignorance. It begins with leaders convinced they already understand the system. Some of today's most celebrated investment strategies depend heavily on pattern recognition algorithms trained on historical market behavior. But those systems quietly assume the future will resemble the past closely enough for prediction accuracy to remain stable. Ackman's collapse revealed what happens when leaders trust historical pattern repetition too strongly. Modern financial ecosystems are now scaling that same assumption through automation. which raises a dangerous, unresolved question. Are today's most advanced analytical systems increasing market intelligence or industrializing the next generation of blind spots?